Hey folks, it's David here at the Property Factory, and today I want to talk to you about the investment capacity report. What is it? Why do we use it? How do we use it? Why is it so important? And the investment capacity report's really focused on helping you understand your current position in terms of your balance sheet, if you like, assets less liabilities, as well as your income capacity or income horsepower based on existing personal income, existing investment property income if you already own investment property, and then we wash all that up and use some analysis to figure out whether you're weaker on equity or you're weaker on income, because those two drivers are really the focus that the bank has on how much they can lend you. All right, so for most investors, probably 90%, they're generally more heavily weighted one way than the other. They've either got tons of surplus equity because they've been in investment for a long time, or they've got really, really high income and they're weak on equity. They might be younger, they might have spent their money on other things, they might have great jobs, but be weak on equity. So those two things really govern the property purchase decision, because if you're weak on equity, what do you want to buy for? You want to buy for instant equity or equity upside through capital growth. Whereas if you're weak on income, then focusing on yield and focusing on cash flow is really important, because if you have a lot of equity but you're weak on income, then again you're going to run out of borrowing horsepower quickly if you're buying property that's poor performing from a yield point of view. So I'm going to dive into three case studies and show you three actual reports. The names have been changed, of course, but three actual case studies that really show you the difference between high equity, high income, or reasonably well balanced in between. So let's go have a look at the investment capacity report. So in the first example, we're going to look at Jane Seymour, who's strong on equity and weak on income. So in Jane's report, we can see that her gearing is to 23.8% based on total assets less total liabilities. Her income's around $100,000 when you combine rent with personal household income. Her net equity, including cash and bank, is $800,000. And on that basis, Jane's got the ability to borrow and purchase $3 million worth of property based on equity, but only $1.057 million worth of property based on income. So in Jane's case, she wants to buy higher yielding, higher cash flow property to weaken up the income side of her equation, because she's got plenty of equity. So in Jane's case, when we put together a forecast of what's possible for Jane, we look at three different scenarios. In a conservative scenario, Jane could purchase 5 properties over the next 10 years and, using pretty typical averages, build her portfolio equity from $800,000 today to about $3.9 million in 10 years' time. To do this, she'd get to a maximum loan-to-value ratio of 64% and she'd be buying on 4.5% yields. In a typical example, where Jane builds a portfolio of an additional 10 properties over the next 10 years, you can see then her property equity will increase from $800,000 today to $5.8 million in 10 years' time, and an LVR ratio hitting a maximum of 68%. And in the third scenario, a more aggressive scenario, Jane would purchase 15 properties over the next 10 years based on her starting position today and building portfolio equity of $7.3 million on a maximum LVR of 70%. So those are the three scenarios we'd put in Jane's report based on what's required and what's best for her position. Okay, so the next investment capacity report we're going to look at is John Chan. John's the opposite to Jane. John's weak on equity and much stronger on income. So we look at John's numbers here. He has household income of $450,000 a year, rental income on top of that of $49,200 a year, but he's quite highly geared. He's geared to 65% right now, and net equity is $380,000. So what that means for John is his borrowing power based on income is actually really high, $4.4 million, based on purchasing investment property that yields 4.5%, etc., etc., etc. So, but when we look at John on equity, he's limited to buying power of $525,000. So for John right now, his next step, his next focus has to be buying for capital growth and buying the types of properties that are going to grow more quickly, improving growth locations. Otherwise, John's going to have an ongoing shortage of equity and not being able to fulfill his potential from a portfolio building point of view. So despite all of this, John's starting point allows him conservatively to purchase 5 properties over the next 10 years and take his equity from $380,000 today to $3 million in 10 years' time, higher at a higher LVR ratio than Jane, hitting 75% there. He's also got the option with a more typical plan to purchase 7 properties over the next 10 years and increase his equity further. And if he's more aggressive in terms of his buying and reinvestment strategy, then he can purchase 9 properties over the next 10 years, taking his equity today from $380,000 to about $3.6 million. So much more limited from a growth point of view, because the lack of equity is really limiting John's ability to move forwards. So you can see right there that at the end of 10 years, not a big gap, and partly that's limited by how fast John can grow his portfolio in the early few years, and with limited equity, of course, he can only move so fast until he starts to get capital growth on that widening base of property. Okay, so the next and final report we want to go to is Mary Smith. So Mary's more balanced as an investor, and let's look at her numbers. So Mary's got net gearing of 24%, household income of about $107,000 when salaries and rents are combined, net equity of $276,000. And so unlike the previous 2 examples, we can see there that on both buying power based on surplus equity and buying power based on surplus income, that Mary can purchase about $1.1 million worth of property right now. So Mary's more balanced, so her approach to her building her portfolio is going to be more focused around taking a balanced approach as she builds a portfolio with both high growth and high yield properties, and keeping it balanced as she steps forward. So again, in Mary's example, 6 properties in 10 years is a conservative plan, seeing her build that equity from $299,000 today to about $2.6 million. A typical plan would be 9 properties in 10 years with her starting position today, and again, maximum LVRs of 72% along the way. And on an aggressive plan, Mary might have the potential to buy 12 properties in 10 years. And again, unlike John, because she can purchase early, she gets the benefit of higher growth over the longer term with her portfolio, and despite starting in a weaker position in terms of equity, she can still get to a pretty similar level to John, which she's got a balanced portfolio to start with, and she can invest regularly in the early years as well. So that's a quick wrap up on the investment capacity report, and what we're going to look at next is a property matching report, and how we then go and match the types of properties to these 3 examples that make the most sense. But as an investor, when you're working with a property factory, the first step to take when you work with us is to request your investment capacity report, because unless we know where you're strong and where you're weak and what you need to do next, we really can't help you from a property acquisition point of view. It's about knowing your numbers. It's about building a balanced portfolio or bringing it into alignment if it's out of whack right now. And it's about buying on the numbers and buying the types of properties that help you strengthen the weaker side of your portfolio.